So we're joined this morning by Stephen Nash, firstly from FIIG Securities. And Stephen, good to have you on board with Carson and I this morning. Give us your thoughts, though, on the extent to which the bond market's actually already pricing in the idea of a Greek default. Because maybe this wouldn't be big news for the market in terms of the actual downgrade itself.
Yeah, look, the markets have been, the spreads on Greek debt have been quite wide for quite some time. There was a small widening on this announcement. 3 notches is a very large downgrade. I imagine that this also signals an increased conservatism by the rating agencies, who are a little bit behind the game here, who've been slow to downgrade and now accelerating these downgrades at a time. It's very difficult for Greece right now, but really markets have been in front of this, and it's really, I don't think it's too much of a shock for the bond markets.
What did you think of the bounce in the euro? There was an immediate response to that news, as you might well have expected, but then there was a remarkable push higher. Was that something that took you by surprise?
Well, it's now, I think the focus is going on the other hot spots in Europe, and that's Ireland and Portugal. We've had the Ireland elections, and there has been some talk about changes to what Ireland will do with their debt and the restructuring of that. And I imagine also the Portuguese situation, there's pressure there. I think for these 3 peripherals, the EU is going to be very careful right now, and I think there'll be some statements and maybe some purchasing by the ECB to calm markets down in the wake of this downgrade.
Yeah, let's bring in at this point Sally Old, who joins us from JP Morgan as well. Sally, thanks for being on the program as well. What can be done the next couple of days, maybe by the Eurozone leaders at this meeting coming up, to allay some of the fears that seem to be re-emerging overnight with the Greece downgrade?
Yeah, good morning, Brooke. Well, I sort of think it's interesting. I mean, our view at JP Morgan is that markets are probably a little bit too optimistic on what's going to come out of Europe over the next couple of weeks. I mean, there's quite a lot of event risk going on, and I think the market's looking for some pretty generous concessions, so upsizing the size of the EFSF facility, lowering the interest rate, all that sort of stuff. So we actually see risk of near-term disappointment, and therefore sort of think maybe in Europe at least trading just a little bit more cautiously, given the risk that European policymakers don't actually deliver the big package that markets, we think, currently expect.
Well, have those expectations changed, Sally? Because that extreme vigilance that Jean-Claude Trichet trotted out just a few days ago, this was ahead of these latest developments. Is that in hindsight looking preemptive?
Well, it's an interesting question, Carson, because I think the way the market was sort of taking it was saying, well, the ECB, whenever they use that strong vigilance phrase, means pretty much, if history is any guide, that they're going to hike rates in the next month, in the coming month, and so the market is geared up for a rate hike in April. And I think people are sort of extrapolating from that and saying, look, there's no way the ECB would be considering hiking rates if they didn't think that European policymakers elsewhere in Europe were going to come up with a package that was going to satisfy markets. And I think this is sort of, the sort of dangerous territory for markets in the next little while. But remember that the ECB has been very clear about separating its, responsibilities in terms of the financial system, so the excess liquidity and some of the other policy measures, from those sort of policy moves that are all about its inflation mandate. And with the way the growth numbers are turning out and have turned out in Europe, and the inflation numbers surprising on the upside, I still think the ECB is going to want to sort of get a little bit more control back over those macro fundamentals, and they seem pretty clear about their intentions to lift rates in the next couple of weeks.
And Stephen, from where you sit, those macro fundamentals, though, they're not evenly going in one direction, are they? We've just been talking about Greece and Ireland, who would be welcoming more pressure to come into bear on the euro, more selling pressure. This is going to put a bid in the other direction if Jean-Claude hikes as expected.
Yeah, I think the ECB looks like they've locked in that rate hike. I'm wondering what happens next. I think the markets are possibly going for a series of hikes. I don't think that's going to occur. I mean, as Sally was saying, we're going to get a lot of pressure from these peripheral countries. The austerity measures have been taken, but really the implementation is occurring now, and the effects of that will be quite severe in the European summer ahead.
And so, Stephen, Sally, actually, detail to us how you think the RBA is influenced in coming weeks, specifically, and interest rates here in Australia are affected by all of this then.
Yeah.
Yeah, I guess. Sorry, Steve. No, it's been one of the issues for the RBA is that they've sort of been going it alone over the last couple of years. I mean, they started their tightening cycle back in October 2009, way before any other central bank, and in fact at a time when other central banks are actually still easing policy. So the RBA, I think, one of the biggest things that concerns them is that the global economy is doing well. There's a lot of excess liquidity, and I think they'll be quite happy to see other central banks actually sort of starting to join the global tightening move. And we've got to remember that these banks are tightening policy from extremely accommodative levels. So, you know, they're only early steps, but I think that'll probably give the RBA a little bit more confidence that, you know, we're not going to run the risk of this sort of huge liquidity and an inflation boom globally simply because central banks elsewhere aren't doing their job. And I guess at the margin you can make the argument that maybe it means the RBA has to do a little less, or maybe gives them a little bit more time to implement their tightening.
And Stephen, your thoughts as well?
Yeah, I think the RBA needs a little bit more time, a little bit more information in order to move policy into the highly restrictive band. Oil prices trending towards $120 is not good news for the global economy. As Lockhart was saying last night, if we get a $150 oil price, there may be moves to implement QE3. So I think that's the series of events we're looking at. As oil trends up, there'll be more talk of further monetary easing, and that may again give the RBA extra time.
We'll wrap it up there for today. I think, guys, we might be out of time. Thank you so much. Thanks. Sally Old from JP Morgan, Stephen Nash from FIIG Securities. Thank you, and Carson with me, of course.